Chapter 6. No investment is risk-free. It's a dangerous world even for those hiding out in savings accounts. And now that you are a committed saver, you have to figure out where to stash this monthly saving, and should you go for stock with their promise of high returns, or maybe favor certificates of deposit with their comforting reputation for safety. To start with this brutal truth, no investment is free of all risks. Investment can usually be slotted into one of four categories like stocks, bonds, cash investment, and hard assets. How much you invest in each will depend on your goals, your time horizon, and your stomach for risk. This notion of risk, however, can be a tricky one. At times, each of four may seem like the low-risk option, but don't be lulled into complacency. In the right circumstances, all four can go badly wrong, and the good news, all four probably won't go wrong at the same time. Sharing the pain. The four categories of investment are, of course, quite different. Stocks allow you to become part owners of publicly traded corporations, and you should benefit as dividends are paid and rising earnings drive share prices higher. Meanwhile, when you buy bonds and cash investment, you become a lender and earn interest in return for the use of your money. Cash investment, like a saving account and money market funds, shouldn't fluctuate in value, while bonds will rise and fall in price as interest rates changes. Finally, hard assets encompass a grab bag of investment, including real estate, gold, commodities, and timber, all of which tend to be a good hedge against accelerating inflation. Folk will look at this menu of choices and make all or nothing decision. I don't want to lose money, so I'm sticking with money market funds, declare some. I want the highest possible return, so I'm buying stock, pronounce others. But this lopsided investment strategy can put you in a grave financial peril. You stand to benefit greatly if things go your way, but you also leave yourself heavily exposed to that investment's own peculiar risks. Stocks, as well as hard assets such as gold, shares, and commodities, are typically considered the most treacherous on investment because they can give up 20% of their value in a matter of months and sometimes far, far more. When the stock market slumps, the losses often come with a breathtaking speed, as we were reminded in late 2008 and early 2009. To gauge short-term risk, investors often look to statistical measure of volatility such as standard deviation and beta, which give a sense for how much an investment bounces up and down in price. To be sure, upside volatility, otherwise known as making a truckload of money, may not seem like much of a risk, but the upside volatility is frequently a sign of downside potential. In other words, what goes up fast can unfortunately come crashing down just as quickly. You can mute this risk by spreading your money across a host of different stocks. This broad diversification has three benefits. First, it damps down volatility, as the decline in some stocks may be partially or entirely offset by the gains posted by other shares. Second, diversification reduces the risk that you will be wiped out because one or two companies plunge in value. And finally, broad diversification lowers the risk that your return will lag for behind the market averages. For most people, typically the cheapest and the easiest way to get broad diversification is with mutual funds and exchange-traded index funds. Diversification, however, does not eliminate all risks. Even if you own a broad collection of stock funds, the rest is likely to be rough. The good news, in return for suffering the wild short-term price swing, stock will hold out the possibility of healthy long-run returns, and this is the classic notion of risk getting rewarded. Stocks are higher risk than bonds, while bonds are higher risk than cash investment. That means a broad collection of shares should beat bonds, which in turn should beat cash investment. According to academic and other research, stocks have historically been the big winner, beating inflation by 7 percentage points a year, while bonds have outpaced inflation by just 2 or 3 percentage points, and cash investment have barely beaten inflation at all. But there are no guarantees stock will continue to win. After all, if the eventual triumph of stock was a sure thing, they wouldn't really be risky, and they wouldn't need to overthrow the prospect of higher returns to get people to buy them. And even if stocks do eventually triumph, you may have to sell before victory is declared. Historically, we have had long period of losing stock return with the share prices going nowhere for a decade or longer, and occasionally stock investors have been wiped out entirely as well, and political turmoil have caused the closing of some national stock markets. We tend to discount the change of such extreme event, yet unfathomable things happen in the financial markets with a surprising frequency, and that suggests a little caution is probably in order. Hedging our bets. The prospect of losing stock return on shatter markets from some folk to issue stock and load up on bonds and cash investment. Make no mistake, when the financial markets suffer one of their periodic meltdowns like those of 1987, 1990, 1994, 1998, 2002, until 2002 and 2008 until 2009, it's enormously comforting to have a little money in conservative investment. And moreover, if you are retired, prudence dictates to keeping some money in bonds, certificates of deposit, and similar conservative investments, so you have a way to get cash without having to sell stock at a fire sale prices. Keeping everything in bonds and cash investments, however, has a risk of its own. Stock may suffer rotten short-term results, but they can also deliver healthy long-run return. By contrast, bonds and cash investment might offer short-term stability, but they may not provide the return you need to achieve your financial goals, and they can leave you at the mercy of inflation. In fact, while pledging market garnered the big newspaper headlines, inflation is arguably a far more sinister threat. This is a key reason to own stock and maybe also keep a portion of your portfolio in hard assets. Historically, stocks have provided long-term protection against inflation. Thanks to their superior return, hard assets may not rival the long-term returns offered by stock, but they have sometimes provided useful short-term protection, posting gains when accelerating inflation has caused stock and bonds to slump. For further inflation protection, you might allocate a significant portion of your bond portfolio to inflation indexes. Treasury bonds, the principal value of these bonds and the interest they generate rising along with inflation. All this leaves many investors in a quandary. They don't like the modest return from high-quality bonds and cash investment, but they also don't like the volatility of stock and hard assets. What to do? For many, the best solution is to own a little of everything, buying bonds and cash investment for downside protection, purchasing hard assets as a defense against unexpected inflation, and investing in stock for their long-run returns. That strategy will never earn you the highest possible performance, but it will limit your portfolio risk, and risk is well worth focusing on. You can't be sure how the various market will perform, but you can control how much risk you take. Compromising our future seems reasonable. Some don't think so, then they go searching for alternative. The result is often an unhappy compromise. For instance, some investors stick with the income-paying investment like a bond and prefer stock, but they hunt for securities that promise hefty payout. The problem is there can be a big difference between yield and total return. An investment long return takes into account not only the yield that gets paid, but also any changes in investment price. The danger, you get the fat yield at least for a while, but you end up putting your principal at risk. Consider a high-yield junk bond fund, and these ones often boast double-digit yields, but part of that gain may slip away as some junk bond issuers go bust, and the default drag down the share price of those funds that own those bonds. Other folk favor investment or strategy that seems to offer both upside potential and downside protection in a single package. Writing cover a call option, market timing mutual fund, and equity index annuities all aim to combine these twin goals, but they may end up giving you the worst of both worlds, delivering mediocre return and involving hefty costs. Yet, others walk to investment that hold out the prospect of high return but appear to our safety. That appearance stems from the absence of daily pricing, and think about investment like a real estate, hedge funds, private companies, and private loans, and this can feel safe because we don't see the daily turmoil that can afflict stock, bonds, and other readily traded securities. But the fact is, if this investment offer high return, they must involve high risk. We may not see the price drop day by day, but we can wake up on one morning and discover we have lost a big chunk of our investment. My advice: be leery of this alternative. Stick with the simplicity of plain vanilla, low-cost mutual fund and work instead on your expectations. For instance, you might mentally divide your nest egg into save money and growth money, and then tailor your expectation accordingly. Invest the growth money in stock funds and riskier bond fund. Expect a wild ride and hope to get rewarded for it. Meanwhile, stash your safe money in conservative investment, knowing the return won't be great, but also knowing you will get stability. When the markets are flying high, enjoy your growth money skin. When markets plunge, turn to your safe money for solace, but that still leaves a crucial question. How should you divide up your nest egg between safe money and growth money? That is where we turn next. Street smart, the four big investment categories: stocks, bonds, hard asset, and cash investment, all have their risks, so avoid getting everything on any one of these categories. As you design your portfolio, focus on not only on reducing the change of devastating short-term losses, but also on defending of the long-run threat from inflation. Chapter 7: Portfolio Performance. It's all in the mix. Our stock bond split powers our investment results. This decision don't get much bigger than this. How should you split your money between stocks and more conservative investment, such as high-quality bonds, certificates of deposit, and money market fund? As the last chapter suggested, this basic mix will heavily influence how erratically your portfolio performs in the short term, but it should also drive your long-run return. Want to boost your nest egg's performance? Forget trying to pick high-flying stock and winning mutual funds. The road to success may be far easier. Bolstering return. Let's start with the obvious. We can expect stock like a return from high-quality bonds, certificate of deposit, and other conservative investment. And unless things go badly wrong, we shouldn't get bond-like returns from our stock over the long haul. Indeed, the basic asset allocation decision, how we divide our money between stock and bonds, cash investment, and hard assets, is one of the most crucial financial choices we make. This key decision not only drives our portfolio's short-term fluctuation, but also it will have a huge impact on our long-run performance. The implication: if we want to improve our return, we might simply allocate more of our money to stocks. Suppose you have 60% of your money in stock and 40% in bonds, and you expect stock to clock 10% a year and bonds to notch 5%. With a 60% stock, 40% bond mix, you are looking at an 8% expected portfolio return. Tough, of course, there is no guarantee your expectation will be met. To increase return, you could bump up your stock allocation to 70%. That would raise your portfolio expected return to 8.5% without doing anything particularly clever, like picking better stocks, selecting superior mutual funds, or trying to guess which way the stock market is headed. It is one of the easiest ways to bolster your potential return, and yet one rarely discussed. Before you go ahead and push your stock holdings, consider 3 caveats. I alluded to 2 of them in the last chapter. First, there is no assurance stock will outperform more conservative investment. Theory says they should. After all, why would people take the risk of owning stock if they couldn't reasonably expect a higher reward? That reward, however, is not guaranteed. If it were, there wouldn't be any risk involved. Second, even if the broad stock market fares just fine, there is a chance your portfolio will perform far worse, and allocating more to stock won't help your overall investment performance. One popular Wall Street rule of thumb says you need just 12 to 20 stock to be well diversified. And with 20 stock, you could indeed diversify away a lot of individual business risks associated with any one stock. The trouble is, You might still earn returns that are radically different from the market averages. This is the problem of tracking error, and to combat it, you really need to own hundreds of different stocks to get this sort of broad market exposure. Consider purchasing mutual funds and exchange-traded index funds, which can give you a stake in a wide array of companies for a relatively modest investment. That brings us to a third warning. Nobody should be all stock. If you are 100% in stock, you can noticeably reduce risk with a very little impact on return by adding a small position in bonds. That small stake in bond will also provide psychological comfort and a little buying power when stocks suffer one of their periodic doublings. It's tough to sit tight during bear markets. What to do? If you own bonds, you could do something constructive, like take advantage of the market decline by shifting some of your bond market money into stock. Feeling quashy? Even if the idea of allocating more stock sounds appealing, you need to weigh how much risk you can reasonably take and how much you can truly stomach. The first part is fairly easy and it's based heavily on time horizon and just approaching retirement, and who will soon be living off their saving should go later on stock and stock funds. Meanwhile, those far from retirement and who have a regular paycheck to cover ongoing expenses can take the risk of investing more heavily in stock market. As you consider this general guidance, keep two things in mind. First, as noted in Chapter 1, you may want to invest more conservatively if your job is not particularly secure or your paycheck fluctuates widely. Second, you won't spend your entire nest egg on the day you retire, so you don't need to be completely out of stock when you quit the workforce. In fact, faced with a retirement that could last 25 or 30 years, you might keep half your money in stock fund without the cost. The deadline are more cut and dried, and you will need the money for the house down payment on a particular day. You will spend your child's college saving over 4 years. With these deadlines in mind, you should probably look to ease out of stock when you are 5 years from spending the money involved or for some 5 year stretch. Stock have lost money. By contrast, if you have 10 years to invest, history indicates you should at least break even with the stock and you will likely make a good money. Given all that, you probably shouldn't invest in the stock market unless you have a minimum of 7 or 8 years to invest. And once you are within 5 years of needing your money, you should start looking to sell, and that does not mean you should unload your stock when you are 5 years out, regardless of market condition. If stocks are in the middle of the brutal bear market, you might sit tight for a little longer and hope prices bounce back. But if stocks are buoyant and you are 5 years from needing the money, you should probably take the change to shift out of stock into the conservative investment. While a quick consideration of time horizon can help you figure out how much risk you can reasonably take, it is far tougher to gauge how much risk you can stomach. Everybody's risk tolerance is different, and the portfolio you are comfortable with may be radically different from that favored by somebody of the same age with the same goals and the same time horizon. Moreover, our risk tolerance is not stable. It's easy to be big and brave during rip-roaring bull markets, and it is a lot harder during this relentless bear market decline when the pundits are full of doom and gloom and your neighbors are panicking and selling. Want to know how you will react to the next market downturn? Forget the risk tolerance questionnaires and instead recall your behavior during previous bear market. In fact, you probably shouldn't invest a high percentage of your money in stock until you have lived through a 20% plus stock market decline. During that decline, think about how much you are comfortable investing in stock and then use that as your guideline thereafter. Hitting the target. Once you have decided what percentage of your money you will allocate to stock, you need to stay close to that target, and let's say you opt for 70% stock, bull market will increase the value of your stock, and stock funds pushing your percentage above 70% to get your portfolio back on target, and you will want to rebalance occasionally, selling some of your stock and moving to proceed the bonds and other part of your portfolio that have become underweighted. Similarly, during bear market, your stock allocation will fall below 70% and you will want to do some buying to get your stock allocation back up to 70%. If during bear markets you rebalance back into stock, it will help your portfolio recover more quickly when the markets bounce back. But in general, rebalancing between stock and more conservative investment will hurt your long-run returns, and most of the time, you will likely be cutting back on stock, which should be your best performing assets. Indeed, if you wanted a high return, you would avoid rebalancing. So why rebalance? It's about controlling risky. By rebalancing back to your target stock percentage, you keep your portfolio in line with the risk level you originally settled on. If you didn't rebalance, your portfolio would grow increasingly risky as your stock rise in value, and that means you could get hit especially hard during the next bear market. Rebalancing is best done within a retirement account. That way you don't trigger an immediate tax bill if you sell stock with the big capital gains. If you need a to rebalance with another taxable account, first see if you can get your portfolio back into line with your target percentages by directing your saving and any dividends, interest, and mutual fund distribution to those areas of your portfolio that have become underweighted. While rebalancing is about risk control, it has the added virtue of giving you something to do. Earlier, I mentioned that keeping a little money in bonds will give you some buying power, which you can put to good use when share prices tumble. Similarly, rebalancing also offers a plan of attack, one that can ease a lot of bear market anxiety. At times of financial turmoil, when investors are gripped by a sense of crisis and many are frozen by fear, it can be enormously comforting to have a well-defined investment strategy and the change to put into. Chapter 8: Stocks are worth something. Getting a piece of the economic action. Many folks view buying stock as a little better than gambling, and it's easy to understand why. Stocks soar one day and sink the next, and while billions of shares change hands and pundits wring their hands over the market's direction. Meanwhile, investors facilitate between the large and despair, and last year's whiskey money manager becomes this year's whipping boy, and the current hot stock turns into next year's bankruptcy feeling. All in all, the market seems like one big crap shot, and it's hardly surprising people shy away from stock and stock funds, and especially at the times of market turmoil. And yet, there is more to stock than ticker symbols, stock certificates, and ever-changing share prices. And stock represent partial ownership in publicly traded corporation, offering a chance to share in global business prosperity. Expect world economies to continue growing, with any luck stock will go along for the ride, keeping grounded. Indeed, as we are whipsawed by yo-yoing share prices, it's important to keep economic fundamentals in mind, so we stick with our stock and have a shot at earning those impressive long-run gains. Over the 50 years through year-end 2007, gross domestic product climbed at an average 7% a year, according to the U.S. Department of Commerce Bureau of Economic Analysis, and the economic growth drove up corporate profits by 7% a year, which in turn propelled stock to a 7% annual price gain. Stock on dividends, and you push the stock market average annual total return well above 10%. To be sure, the simplistic description calls for all kinds of caveats, and share prices didn't rise in a lockstep with economic growth. In many years, stock didn't come close to delivering 10%, and we might not average 10% a year in the future. In addition, the full benefits of economic growth may not flow through the shareholders if management reinvests profits incompetently or issues huge number of new shares. Still, during stock market bloodbath like 2000 to 2002 and 2008 to 2009, it's helpful to take a deep breath and consider the three components of the stock market return. First, there is corporate earning growth, and yes, the growth will suffer during recessions. But unless we get an economic apocalypse, we should be moderate earning growth over the long haul as the expanding economy pushes us corporate profits. And second, there are the dividends that corporations pay using a portion of those earnings in a recession. Some company will cut or eliminate their dividends, but if you own a diversified portfolio of stock, the impact shouldn't be too severe. The implication: if you buy a collection of stock and that yield, say 3%, you can reasonably expect to collect that 3%. But while earnings should climb over time and dividends are fairly reliable, the threat component or the market's return is far less certain. We are talking here about the value put on corporate profit as reflected in the stock market's price-earnings multiple. An example: if the company's stock is at $30 and it had earnings per share of $2 over the past year, its stock will be trading at 15 times earnings, and price-earning multiple sure and seeing as investors flit between giddy exuberance and beating despair. In the early 1980s, stock traded below 7 times earning, while in the late 1990s, we got above 30 times earning, and that's an enormous swing in valuation. In fact, in the short term, changes in the market price-earning ratio will often have by far the largest impact on stock return, easily swamping the benefit of earnings growth and dividends paid. Over the long term, however, it's a different story. The influence of a price-earning ratio starts to wane and earning growth and dividends become the key drivers of stock performance. Imagine you are investing for a retirement that's 35 years away, and over the stretch, the market price-earning multiple contract from 20 to 10. The combination of earnings, growth, and dividends would ordinarily give you a 10% total return, but the halving of the market's P/E ratio clearly hurts results, and yet over 35 years, the impact is not all that great, and you would still collect an average 8% a year. Moreover, if you invested regularly over those 35 years, you could take advantage of the market's contracting PE by purchasing shares at a lower valuations. Admittedly, it takes a strong stomach to buy when stock prices are tumbling, but that's why it is important to keep in mind that stocks are not mere pieces of paper. As the market falls, its expected long-term return rises. Shares are now cheaper relative to dividends and corporate profit, which suggests better performance thereafter. Indeed, while tumbling share prices typically cause investors to turn cautious, the rational response is to become more optimistic to understand why, forget stocks for a moment, and consider the example of bonds and bond prices. Yields move in opposite directions. So that yields rise as the bond prices fall, because the bulk of your bond returns comes from the yield, and the benefit of falling prices are all too clear, and yields are no higher. So returns thereafter should be better. A notion that even the most naive investors tend to grasp. Even if you have no additional money to invest in bonds, you can take advantage of the new higher yield by reinvesting your interest payment. Result: rising interest rate can hurt your bond portfolio's value in the short term, while simultaneously raising its expected long-run return. Similarly, falling share prices should make you more enthusiastic about stock, and you can take advantage of the decline by reinvesting your dividends. But given that stock dividend yields are usually lower than bond yields, and reinvesting your dividend won't give you much buying power. Instead, if you really want to profit from slumping share prices, you need to step up the amount you invest in each month and also consider rebalancing. If you keep fundamentals in mind, maybe you will have the courage to do just that. What if stocks rise? Rather than becoming more enthusiastic about purchasing stock, you should become less so. But that does not mean you should stop saving money every month. True, if we have a great returns over the past year, you may not be closer than expected to amazing your target nest egg. But remember, if stocks have raised ahead of the underlying growth in the corporate earnings, the past year's big market gain may have effectively borrowed from the future, and weaker return may lie ahead. As a result, you may not want to buy more stock because they are now more richly valued, but because there is a risk future return will be lower, it's prudent to keep saving. What to do? Instead of purchasing more stock, you might use your monthly saving to buy bonds. Street smarts: whenever stocks show or seeing temporary enthusiasm or fear, by keeping economic fundamental in mind. Take advantage of falling share prices by rebalancing and reinvesting dividends and increasing your monthly purchases. If stocks skyrocket, continue saving, but consider buying bonds instead. Chapter 9. To add wealth, we need to overcome the subtractions. If we are not careful, we will double our money in 47 years. Like a magic money machine, minting millionaires on a daily basis. Getting it is one thing, keeping it is another. The financial market can boast astonishing one-year returns such as the 30% plus gains clocked by the Dow Jones Wilshire 5,000 stock index in 1985, 1991, 1995, 1997, and 2003. Indeed, at times, Wall Street can seem like a magic money machine minting millionaires on a daily basis. But dig a little deeper and you'll find investors are not faring nearly as well as viral written suggests. Why not? At issue here is the triple threat of investments cost, taxes, and inflation. If your portfolio is not overcoming those big three subtraction, you are not making any money. Slipping away. Imagine you hold a classic balanced portfolio consisting of 60% stock and 40% of bonds. Before all subtraction, that makes delivers 8% a year, which is enough to double your money every 9 years, and thanks to investment compounding. But even if your investment earn an 8% raw return, you will pocket far less if you are careless about investment costs and taxes. For instance, you could easily lose 2 percentage points a year, and possibly more, the mutual fund expenses and other costs, and that would return your 8% return into 6%. If you are sleepy about taxes and you are in the 25% federal income tax bracket, that 6% may become 4.5%. Inflation might then steal another 3 percentage points and leaving you with just 1.5% a year. At that rate, it will take 47 years to double your money. Sounds grim? You can't do anything about the inflation rate. You also can't insist on better market performance. But there is much you can do. For a starter, you can be sensible about risks, avoiding big bets on one or two stocks or in a single market sector. You can also remain disciplined in the face of market turbulence, restraining your greed during bull market and resisting panicky decisions when shares prices decline. Maybe more important, in reference to our current example, you can pick a low-expense investment or ask your advisor to pick them up for you, and you can strive to invest in a tax-efficient manner. Take our 8% pre-cost, pre-tax, pre-inflation return. Without too much effort, you could probably cut your investment cost in half to 1 percentage point or so every year, leaving you with 7% after a cost return. If you don't bulk your investment inside a retirement account, you would get tax-deferred and possibly tax-free growth, so you hang on to the full 7%. You can read more about the benefit of retirement account in chapter 17 and 18. To be sure, you will still suffer the fully fury of inflation, which is knocking 3 percentage point of your return, and unless instead of notching 1.5% a year after inflation, you would be making closer to 4%, enough to double your money every 18 years. Yeah, the difference between 1.5% and 4% might not seem like much, but over time, the gap would be enormous. And thanks to compounding, if you save $100 a month and earn 4% a year, you would have $118,600 after 4 decades. If you earn just 1.5%, you will pocket a mere $65,800. Trimming the tap. Sounds simple enough. It is, and yet many people pay precious little attention to the investment costs and taxes, and this partly reflects investors' single-minded focus on performance. They are so anxious to find the next hot stock or the next superstar mutual fund, and they fail to notice how much they are losing to costs and taxes. But this partly also reflects the way investment costs and taxes are paid. We file our tax return long after we make our trades and long after we collect our dividends, interest, and mutual fund distribution. Not surprisingly, the connection between the investment decision we made and the taxes we pay seems tenuous at best. Meanwhile, whether we invest on our own or we use a financial advisor, it is rare that will receive a separate bill for the investment costs we incur, so it's hard to track how much we are paying. Account maintenance fee and asset management fees are often subtracted directly from our portfolios. Mutual fund expenses are gradually deducted throughout the year. Commissions are usually rolled into an investment purchase price are subtracted out of the sales proceeds. The other big trading cost is the bid-ask spread, which is the difference between the higher price at which market makers will sell us the stock and the lower price at which they will buy it back, and this spread can go entirely unnoticed because it's built into the price. But sometimes the spread will cost us more than the brokerage commission charged on the trade, and true, we can't avoid all investment costs. If we buy mutual fund and hire financial advisors, we should fully expect to pay for their services. Instead, the goal is to understand what we are paying and to ensure the bill is not so onerous that we are unlucky to earn decent return. Take mutual fund expenses. Many bond mutual funds charge almost 1% a year, equal to $1 for every $100 we have invested, while stock funds often charge around 1.5%, equal to $1.5% for every $100 invested. Such a cost makes them inconsequential if we manage to invest with some hotspot fund manager. But as we will learn in the next chapter, picking winners is not easy. Most fund managers don't perform well enough to recoup the fees they charge, which means the typical mutual fund lags behind its foreign benchmark index. Indeed, differences in annual fund expenses are a key driver of differences in fund performance. This is especially clear with the bond and money market funds. Over a 5-year stretch, each bond and money fund category's top performers are also always the fund with the lowest annual expenses. Costs are not quite as big a determinant of differences in stock fund performance. A stock fund manager can get lucky and post big gains despite the burden of a hefty expensive ratio. And still, it makes sense to stack the odds in your favor by sticking with the lower cost funds. If you use a financial advisor, you can get your advisor to do the cost cutting for you. And today, you might pay around 1% a year for a financial advisor's help. If you don't have much money to invest, you may pay somewhat more. If you have a 7-figure portfolio, you might pay less, and this 1% or so can be charged in a variety of ways. Some advisors get compensated through commission. Some charge a percentage of portfolio's value, and some bill by the hour, and some levy a monthly or annual retainer. If you pay a retainer or a percentage of assets, the sum you are charged will be fairly steady from year to year. If you pay commissions or by the hour, the amount could vary sharply. In return for this fee, your advisor may provide all manner of financial assistance, including building you a sensible portfolio, encouraging you to save, counseling calm at times of market turmoil, and helping with other aspects of your financial life. To your advisor's list of duties, consider adding one other item, cutting your investment costs. Today, depending on the type of portfolio your advisor is looking to build, she could get your fund expenses down to 0.2% a year or even less. In fact, by slashing your investment expenses, your advisor could go a long way toward justifying her fee. But where can you find funds with such low cost? It's time for Chapter 10. Street smart and fret less about short-term performance and focus more on items you have some control over, like how much risk you take, your trading costs, and your investment tax bill, and figure out how much you are paying in investment costs, and make sure the tab is not so onerous that you are unlikely to earn decent return. If you use an advisor, task the advisor with trimming your fund expenses and other costs. Chapter 10. Aiming for average is the only sure way to win. Why the meek will inherit the earth. To earn healthy returns, we need to take a risk. But what if our risk-taking is not rewarded? And this, I fear, is an all too common occurrence. Hungry for a supercharged return, investors bet heavily on a few stocks or some high-flying stock mutual fund, only to find that they are earning lackluster return as the broad market charts ahead. But such setbacks don't deter the gambling set. These folk roll the dice again and again, hoping that their luck will turn, and like lottery ticket buyers, they are buoyed by the occasional small win and they dream of the investment jackpot. But the jackpot never gets hit, and their eventual retirement proves to be a penny pinching affair. Their mistake? These folk fundamentally misunderstand what stock market investing is all about. We don't invest to beat the market, get rich, or earn the highest possible return. Money is not an end in itself, rather, it is a means to other ends. We invest to meet our goals, whether it's buying a home, putting the kids through college, or paying for meeting our match. What strategy will give us the greatest chance of reaching our goals? Earning market-beating investment return will certainly help. Trouble is, if we try to beat the stock market, we also run the risk of lagging behind. The two outcomes, however, are far from equal. In one scenario, we retire richer. In the other, we may not retire at all, given that we all get just a single shot at saving an investment for retirement. It makes sense to avoid strategies that could put our retirement at risk, such as betting the bank on a single stock or a single market sector. Nonetheless, we remain fixated on beating the market. We see stocks that climb 100 or 200% in a single year. We read about superstar mutual funds. We hear about hot little companies with a nifty new invention. We watch great corporations grow steadily year after year. We see how, with apparent predictability, winners turn into losers and bull markets turn into bear markets. The easier money it appears is there for the taking. It seems so simple to pick winning stock, find superstar fund, and sidestep market declines. And yet, it is not. Outpacing the market over an extended period is so difficult that there are winners, such as Warren Buffett, chairman of Berkshire Hathaway, are hailed for their investment acumen and treated like celebrities. Why do so few triumph? Here are 10 reasons. 1. Cost drag down results. As discussed in Chapter 9, investment costs can put a big dent in our return. The logic, I'm afraid, is brutally simple. Before investment costs, we collectively earn the stock market averages. After costs, we must, as a group, lag behind. In fact, we will collectively trail the market by an amount equal to our costs, and some lucky souls will overcome this harsh arithmetic and emerge victorious, but most of us won't. This logic is especially troubling for those hell-bent on beating the market. We like to think that hard work will pay off in investing, just as it pays dividend in other parts of our life. The problem is, working hard at investing often means incurring more investment costs, whether it's research expenses, money management fees, or trading costs, and therein lies the rub. The more we spend trying to beat the market, the tougher it is to succeed. Number 2, markets are smart. Even if most investors fail, maybe you could find a way to win. One obstacle: markets are reasonably efficient, meaning they reflect currently available information. Take XYZ Corporation analysis. On average, expect its earnings to climb an impressive 30% over the next year, but that's hardly a reason to buy the stock. Investors already know about those expectations, so they are presumably fairly fully reflected in the company's share price. Instead, what drives market is news, which by definition is something we had not previously known about, and that news might be a change in analysis, earnings forecasts, the latest economic data, a corporate earnings announcement, some political development, or even an offhand comment by a company executive. Once this news breaks, it is quickly built into stock prices, so it's tough to profit even if we react immediately. All this can be discouraging if you are aiming to outpace the market, because market quickly incorporate all known information. It is hard to get an edge no matter how well informed you are. But what hurts so the savvy helps the ignorant. Uninformed investors are protected by market efficiency. They may shut themselves in the foot by trading too much and making risk bets, and still, when they buy a stock, they can be reasonably confident that the share prices reflect all currently available information. Number 3, the competition is tough. You are unlikely to dig up information that others don't already have and that is not already built into market prices. You could, however, do a better job of analyzing existing information, but will you? As you confidently buy and sell, you may imagine yourself competing against the market, some bloated entity that you can easily outwit, but in truth, you are competing against other investors. Consider again XYZ Corporation with its expected 30% profit growth. You have analyzed the company financial statement, you have considered the firm's market position, and you believe corporate profits will be even better than analysts expect. As you load up on the shares, there will be investors on the other side of the trade, happily dumping their stock. They too have no doubt analyzed the company's financials, consider its market position, and wonder about its growth potential. And they may be professional money manager with a business degree, high-power computers, years of experience, and access to the latest stock market research. Are you sure you know more than they do? I'm not trying to dissuade you from ever again buying or selling an investment. If you are going to retire in comfort, you will need to pick out a diverse collection of mutual funds that give you broad market exposure. Add to them regularly and occasionally revamp the mix. Not unless as you manage your portfolio, a little humility is in order. Maybe the folk on the other side of the trade really do know something you don't. So maybe you shouldn't bet too heavily on any one stock or stock market sector. Number 4, no strategy always wins. There are all kinds of strategy for selecting individual stock. Some investors look for high-flying growth stock or growth at a reasonable price, or high-dividend stock, or stock that are trading below their intrinsic value. For a while, any one of these strategies might be highly profitable, but don't count on them being always profitable. Partly that's because of the costs involved in implementing this and any other investment strategy, but partly, too, it reflects the competitiveness of the market. If a stock picking strategy proves superior, it quickly becomes popular. Soon, legions of investors are using the same criteria to pick stock, and their buying drives up the price of the favored companies. Because prices are higher, future return will be lower and the strategy stops working. Number 5, investment trends die. Okay, maybe you'll forget that this is the business of picking individual stock. Instead, you will look to ride the hottest market sector, betting on them by buying a basket of stock or a narrowly focused mutual fund. And that way, it doesn't matter if a few stock crash and burn. At first blush, this doesn't seem so foolish. There is some evidence of momentum in the stock market. Investment that perform well 1 year out often continue to fare well in the year that follow. It may be that when prospects improve for a company or a sector, investors initially underreact to the good news. But as the good news continue to flow, doubtful investors become believers, and this investment extends their winning streak. And because of this sort of market momentum, if you own an investment that posts strong short-term result, you probably shouldn't be too quickly to cash in your gains. But that doesn't mean you should rush to buy into hot sectors. It's hard to make money from market momentum, especially if you are doing a heap of trading and thus incurring high investment costs. Moreover, timing these things is tricky. Some market trends never gain traction and some last far longer than expected, and those who bail out early are left kicking themselves. Those who buy late may see the trend as invincible and further gains inevitable, but such trends always come on to the end, and sometimes with a whimper and sometimes with a bang. Think about healthcare stock in the early 1990s, technology shares in the late 1990s, and housing stock during the recent real estate boom. At their dizzying peak, buyers were convinced the sector would generate dazzling gains for years to come and price raise far ahead of what economic fundamentals would justify. But the fundamentals eventually prevailed and the sector plunged back to earth. One additional warning: some investors imagine that if they buy, say, an aggressive growth stock fund, the manager might be able to sidestep the carnage if the sector goes into a tailspin. This, I regret, is unlikely. Most managers are not that prescient, but even if they were, funds tend to have tight investment charters that restrict their managers to picking security from one part of the market. If that part of the market suffers, so will the fund's shareholders. Number 6, gains come quickly. Glance at any long-term short stock market chart with its prolonged climbs and punishing bear market, and the appeal of market timing becomes obvious. If you could sell before the decline and buy before the rebound, you could make out like a bandit. And this, unfortunately, is easier said than done. There is no surefire indicator that tells you when stocks are about to plunge or soar. Wait too long to buy or sell, and you could easily miss out your change because market cancel losses often come in quick bursts, and market timing can also mean hefty trading costs, and if attempted outside of a retirement account, big tax bills as well. Number 7. Nothing receipts like a success. That brings us into another possibility. Instead of picking your own stock, maybe you could turn over responsibility to some celebrated stock fund managers and rely on them to make the right investment calls. Even if this manager cannot sidestep market decline, maybe they could beat the market by a few percentage points each year by picking superior stock. Alas, the history of the actively managed stock funds is a sorry one. On average, stock fund managers lag behind their benchmark indexes. You, of course, have no intention of buying average manager. Instead, you plan to buy manager with the superior records. But many apparently superior managers quickly revert to average, and they may have had a good run simply because their stock picking style or the sector they favor were briefly popular. Other managers continue to thrive, but even if they are truly skillful, their success may contain the seeds of its own destruction. Successful mutual funds grow so popular and so big that their superior returns are hard to sustain. The manager of this fund may also grow overconfident, trading too much and taking on too much risk, and that means shareholder of actively managed fund needs to remain vigilant, prepared to move on if a fund's glory days appear to be over. Number 8, skill may turn out to be luck. To make matters worse, it's difficult for most of us to separate savvy manager from the merely lucky, and in fact, success seems so arbitrary that many managers have been compared to monkey throwing darts at the newspaper stock table or gambler flipping coins. Fair comparisons? Suppose that, as with getting hit with a coin flip, there is a 50% chance of beating the market each year. Start with a million investor, and by the end of a dozen years, probability suggests you would have 244 investors who had beaten the market every year. And these 244 would no doubt be celebrated as market-beating geniuses and crowned the next Warren Buffetts. But are these folk really skillful or just lucky coin flippers who come up heads 12 times in a row? The bottom line, simply identifying funds with a good 5 or a 10-year record is not enough to analyze money manager performance properly and separate the skillful from the lucky. It takes top-notch information, careful analysis, and keen insight. And even if you have all of that, and most ordinary investors don't, nothing is guaranteed. Number 9, the deck is stacked. All this may have you scratching your head. After all, most years, there are the spectacular winners and the stock that double or triple in value, and these big winners make a beating the market seem easy, and yet ironically their very existence means you are more likely to lose. To understand why, imagine a market with 10 stocks. One gains 100% this year, and while the other 9 climb 10%. The average gain is 19%, but only one stock beat this average and the rest earn far less. In a less extreme form, this sort of skewness often occurs in the stock market. Each year, the market best stock might leap 150%, 200% or more, and while the worst performer cannot lose more than 100% of their value, the big winners can skew the market average upward far more than the loser can drag it down, and which is why a majority of stocks often end up with a below average performance. The big winners may attempt to bet heavily on a handful of companies, but if you do that, the odds suggest you won't pick superstar stock and you will suffer lackluster performance. Instead, if you want a good shot at keeping up with the market averages, you should diversify as broadly as possible and thus increasing the odds that you will own some of the big winners. Number 10, investing is counterintuitive. If the preceding 9 points tell you anything, they should tell you how utterly maddening investing is. Big winners mean you are more likely to lose. Popularity leads to failure. Success contains the seeds of its own destruction, and past performance does not repeat. Information is not necessarily helpful, and hard work can backfire. Maybe it's no great surprise that most of us struggle when investing, so maybe it's no great surprise that there are so few Warren Buffetts. Matching the market, all this can be a tad depressing. Feel like a giving up? Great idea. Enter indexing, my favorite investment strategy. A strategy you can use whether you are a do-it-yourself investor or you employ a financial advisor. Think about the dilemma we face. We get only one shot at investing for retirement, and the cost of failure is far greater than the benefit of success. We also know that trying to succeed by endeavoring to beat the market is highly likely to fail. What we need is a strategy that has a greater probability of success, and that's what indexing offers. An index fund does not try to beat the market. Instead, it meekly buys many or all of the securities that make up an index in an effort to replicate the index performance. That index might be a stock market index like a Standard & Poor's 500 or the Dow Jones Wilshire 5000, or it might be a bond index such as the Barclays Capital US Aggregate Bond Index. An index fund will almost always fall somewhat short of its benchmark index because, unlike the underlying index, the fund charges expenses, and still, those expenses might be just 0.2% a year, so the shortfall should be modest. Index funds also tend to trade sparingly, which means they are slow to realize their taxable gains and they don't incur a lot of trading costs. Meanwhile, most active investors with their higher expenses will trail the market by far more, and results by aiming for average, the humble index fund ends up winning. That doesn't mean index funds guarantee you will make money. If the underlying index suffered terrible performance, the funds that track the index will also suffer terribly. But unlike investors who try to beat the market, index fund investors enjoy what's called relative certainty. The fortune may rise and fall with the underlying index, but they can be confident that they will capture the index performance minus their investment costs, and active investors who are endeavoring to beat the market can have no such a confidence. Chapter 11. Wild investments can tame our portfolios. Looking to zig when everything zags. Go crazy will feel calmer. At the end of the last chapter, I mentioned specialized index funds that invest in a nice area like commodities, emerging market stock, and real estate investment trusts, and this narrowly focused fund can generate both spectacular gains and stomach-churning losses. Indeed, such a wild investment are periodically popular with the gambling set, those folk who are gunning for the big win, but forget this such a nonsense. As I have argued in the earlier chapters, you cannot forecast return, but you can control risk, and that, ironically, is a good reason to buy this volatile investment. Staying calm. This might have you scratching your head. How can wild investment help you control risk? As you will notice from following the market, investment don't move in lockstep with one another, and sometimes large companies stocks soar, while small stocks struggle. Sometimes foreign shares roar ahead, even as U.S. stock posts modest again, and sometimes everything gets pummeled except maybe a single oddball sector, and consider to the 2000 and 2002 collapse, which saw the broad US stock market cut in half. Technology stock got crushed, but bonds posted offsetting gains, and we got surprisingly good performance from real estate investment trust and small company value stock. Because different parts of the market don't rise and fall in a lockstep with one another, you can reduce your portfolio overall price duration by mixing together these different sectors. When some sectors are sinking, others may be soaring, and this calming down your overall portfolio. This reduced volatility can be enormously comforting. After all, we may be saving for retirement in 30 years, but we still have to live with our portfolio today. If they are a little calmer, we are more likely to stick with our investment, so we earn the handsome return that can accrue to long-term investors. Broad stock market diversification also delivers benefits over the long haul. Even if you have a decade or more to invest, you can get sharply different results depending on which part of the global market you have exposure to. And yet, you may not fully appreciate the risk reduction. Take commodities, which can suffer stomach churning price swings, because commodities often sink while other investments sag, and they may post gains when the rest of your portfolio is slumping, and thus helping to trim that year's overall investment loss. The downside, even if your commodities calm down your nest eggs overall volatility, you may not feel any calmer because you just are not comfortable owning commodities. Also, as critic notes, a globally diversified portfolio often provides comfort during major market melting down when all assets tend to sink simultaneously. But even in this simultaneous sinking, there are often a wide variation in performance. Spreading it around. As you look at the widely varying performance of market sector over both 1 year and 10-year stretches, there is a danger you forget about risk reduction and instead start pursuing performance. This would be a mistake. Unfortunately, in investment world, the question that intrigue us most are the ones we are least capable of answering. We all want to know which stock will skyrocket, where the market are headed next, what will happen to interest rates, and which mutual fund manager will shine. But as the saying goes, if you ask a stupid question, you will get a stupid answer. Any strategy that involves predicting return, especially short-term return, is likely to be a dud because we just are not good at forecasting. What to do? Decide how you will split your money between stock and conservative investment, or alternatively, between growth money and safe money. And this will be the key driver of your portfolio risk and return. And thereafter, forget buying new stock and bond fund for their performance potential. Instead, add a new fund only if you think it will reduce your portfolio's overall risk. Let's say your goal is to own a mix of roughly 60% stock and 40% conservative investment. Start by assuming you will invest your conservative money entirely in a high-quality US bond fund. Similarly, begin with the assumption that you will invest all your stock market money in a broad-based US stock fund, such as a US Total Stock Market Index Fund, which will give you exposure to both large and small US companies because you own both stock and bonds and because you own the broad-based fund and you have already significantly reduced risk. But you could likely do better thanks to the proliferations of mutual fund and exchange traded index fund. Ordinary investor can now build extraordinarily sophisticated portfolios. In fact, you can now put together the sort of investment mix that until 15 or 20 years ago was an option for only large institutional investors. As you strive to lower risk of your stock portfolio, you might begin by adding a significant stake in a fund that track developed foreign market so that you have maybe 70% of your stock market money in US stock and 30% in foreign market. You might further tweak this mix by, say, putting a sliver of your foreign stock money into emerging market and another sliver into small cap stock from developed foreign market. In a small doses, this investment may reduce your portfolio's overall risk. Similarly, on the bond side, you might start by dividing your core bonds position between conventional high-quality US bonds and inflation-indexed treasury bonds. You might then add small position in high-yield junk bonds, emerging market debt, and bonds from developed foreign countries. Again, in small doses, this investment may reduce your portfolio's overall risk. Alternatively, you might choose to keep your bond investing simple, especially if the bulk of your money is in a stock. Indeed, in building portfolios, a popular strategy is to take a risk on the stock side of portfolio while playing it relatively safe on the bond side. By sticking with maybe a low-cost, short-term bond fund, historically, short-term bonds have yielded almost as much as long-term bonds while suffering much less volatility. Chapter 12: Short-term results matter to long-term investor. Keep one eye on the horizon and the other at the ground ahead. Chapter 13: A long life is a big risk. The danger: we run out of money before we run out of breath. Live long and prosper, maybe. Drawing down a portfolio in retirement is one of life's trickiest financial conundrums. We don't know what the inflation rate will be and what surprise expenses will face, and we don't know what long-run return we will earn and when the next bear market will hit. On top of all this, there is another big uncertainty. We don't know how long we will live, and that means it is hard to gauge how much money we can safely pull from our nest egg each year. And we draw too much and we could outlive our saving. We draw too little and we may spend our retirement scrimping unnecessarily. What to do? Welcome to the world of longevity risks. Outliving the averages. Life expectancy can be a tad confusing. Some folk look a little at life expectancies as of birth, but such averages are dragged down by those who die before they reach retirement age. Instead, if you are thinking about spending down a portfolio in retirement, you want to focus on life expectancy of age 65 today. A 65-year-old man can expect to live until age 83, while a 65-year-old woman can expect to live until 85. But even these numbers are misleading because they are just averages. Not only will half of retirees live longer, there is also a huge variation. Around these averages, some people will die in their late 60s or early 70s, while a sizable minority will make it to age 90. Moreover, if you are married, you are dealing with two life expectancy, which means there is a good chance that at least one of you will live beyond your life expectancy. Also, keep in mind that the average of reflect the general US populations. What about well-educated affluent folk who exercise regularly, do not smoke, drink in moderation, and read personal finance books? They will likely live longer than average. And the bottom line, unless you are in a poor health when you retire, you should probably err on this side of caution and plan for a retirement that extends to age 90 and maybe beyond. To complicate matters, there is inflation. At 3% a year, the spending power of a dollar is cut in half in just 20 years, which means the fixed pension you receive at age 65 will buy just half as much as age 88. And if anything, this understates the problem. The general standard of living rises not with inflation, but with the per capita economic growth, which typically climbs some 2 percentage points a year faster than inflation. This is why retirees often feel pinched even if their incomes are keeping pace with inflation. Incidentally, this is also why it's so hard to keep family fortune intact. After incomes is distributed to family members and tax are paid, it is unlikely the family fortune will grow very much over the long haul, and yet alone match the rate of per capita economic growth. And if the family fortune is not maintaining pace with the per capita economic growth, it can be kick off income over the long haul that will allow family members to keep up with the general standard of living, making it last. So how can you arrange a retirement income stream that rises over time and that lasts at least as long as you do? The precise strategy you settle on will depend on a fistful of factors, including your appetite for risk, whether you have a pension, how much you have saved, whether you are married, your current health and likely longevity, and whether you are looking to leave behind a substantial estate. Still, as you design your strategy, keep in mind some key notion. For a starter, forget the traditional approach favored by a retiree, which is to buy bonds and live off the income. That will leave you vulnerable to inflation, as the suspending power of both your interest income and your bond's principal value is gradually eroded. To counteract inflation, you need to reinvest part of your annual investment gain back into your portfolio during the early years of retirement, so that your nest egg growth comes close to rivaling inflation. The trouble is, if you are investing entirely in bonds, certificate of deposit, and other conservative investment, the state to reinvest likely won't leave you with much money to spend. Indeed, this is why you should seriously consider holding some stock funds, so you have a shot at earning healthy inflation-beating gains. And sure, this is risky, but you can manage the risk with the cash cushion strategy described in the previous chapter. While holding stock can make retirees nervous, they often have plenty of time to ride out the rough market. Retirement is not a hard deadline. Like buying a home or paying for a college, you might spend down your portfolio over 30 years, and your investment time horizon may even extend beyond your lifetime. Suppose you are age 65. If you plan to bequeath part of your portfolio to the children or grandchildren, you might be dealing with a 50 or 80-year time horizon. It's hard to imagine stocks wouldn't generate handsome gains over that long a time frame. To counteract inflation and ensure you have a healthy amount of income, also consider delaying Social Security. You can claim Social Security retirement benefit as early as age 62 or at as late as age 70. The longer you delay, the larger your monthly check will be. In fact, if Social Security remains in its current form, and its cutback, it may prove to be your most valuable retirement assets. After all, it's government guaranteed, inflation linked, at least partly tax free, and you get it for life. In addition, Social Security comes with both a spousal benefit and a survivor's benefit. And suppose you were the family's breadwinner. Even if you are in a poor health, you may want to delay claiming Social Security to get a larger monthly benefit because your spouse will likely receive your benefit as a survivor benefit. In effect, the life expectancy of your Social Security benefit is longer than your own life expectancy. If you have a pension, that will give you another source of lifetime income. No pension, to supplement Social Security, you might sink part of your nest egg into an immediate fixed annuity that pays lifetime income. A lifetime income annuity typically does not have any principal value. Instead, all it gives you is a stream of regular income for as long as you live. Cast your mind back to the strategy discussed in chapter 12. Let's say you earmark 25% of your saving for a cash cushion and another 50% for stock fund, and that leaves 25%. As suggested in chapter 12, you could put this 25% higher yielding US and foreign bonds. Or alternatively, you might invest in a lifetime income annuity. The annuity will likely give you more income than the bonds, and the annuity streams of income is guaranteed for life. And many folks dislike immediate annuities because they fear they will die early in retirement and the money they sunk into the annuity will be gone. And still, if your nest egg is on the small side, an immediate annuity may be a good bet if you need a healthy amount of income. If you are not keen on buying an annuity, you might instead to take maybe 20% of your nest egg at age 65 and set it aside to grow until age 85. Think of this as your financial backstop in case your life is surprisingly long time. In the meantime, you can spend on the other 80% between now and age 85. If you die before age 85, and the 20% will go to your heirs along with any other saving you have left. And what if you live to the age 85? At that conjuncture, you will have a choice. If your health is shaky, you could spend on the 20% you set aside, but if your health remains robust, you might use this saving to buy an immediate annuity that pays lifetime income. Because of your advanced age, the annuity should offer a handsome monthly payout. Need additional income? If you own your home, you could always tap into its value through a reverse mortgage. Chapter 14. Markets may be rational, but we are not. Investing is simple, and yet it's sure it's not easy. Sensible money management is a pretty straightforward. We need to save regularly, control risk by a few funds, hold down costs, and keep half an eye on taxes. As I hope I have made it clear in preceding chapters, investing can be remarkably simple. And yet it sure is not easy. We make all kind of behavioral mistakes, including saving too little, growing overconfident as the market rise, losing faith with the share prices tumble. And that doesn't mean we all make the same mental mistake and share the same behavioral quirks. But some of these quirks are pretty widespread and they hurt many folks' investment result. All this represents a partial repudiation of a classical economic which assumes our behavior is rational. Rational? Think about the next time you fail to go to the gym, eat the chocolate you swore you wouldn't touch, spend too much at the mall, and once again rack up the shocking credit card bills. Struggling to save. Indeed, our behavioral struggles start with our lack of self-control, which means we find it tough to delay gratification and we end up saving far too little. As I suggested in chapter 4, this may have evolutionary roots. Our hunter-gatherer ancestors didn't give much thought to how they would pay for retirement. Instead, they were focused on surviving, which meant consuming whenever they could. Maybe it is no great surprise that delaying gratification does not come easily to us today, and why we need to engage in all kind of trickery to get ourselves to save. As a substitute for trickery, you might imagine that we could try financial education. The trouble is, education does not appear to work. We all know we need to save, but we still fall short. For instance, if we ask whether starting a year from now we would willing to cut out some luxuries on terabytes, save an extra $100 extra a week, we might say yes. But if we are asked whether we would be willing to start the belt tightening immediately, we would likely balk. We know that what is good for us is the long term, but because it is the long term, it is easy to procrastinate, like the sinner's prayer. God save me, but not yet. While a lack of self-control is probably the biggest reason we don't save enough, we can also blame our profligate ways on our inadequate math skills. Most of us don't carry around financial calculators. Instead, when confronted with everyday financial math problems, we guess, and our guesses are usually not very good. For instance, we may be aware of the effect of compounding and the process by which we earn investment gains not only on our original investment, but also on the gains earned in the early years that we reinvest that back into our nest egg. But while we have some sense for how compounding works, we tend to underestimate its impact. That means we don't realize how much our saving could grow over time, and thus we are not as motivated to save as we should be. By the same token, we underestimate how much our debts are costing us, and we may not know that our credit card charges a steep interest rate, but we don't fully appreciate how much interest we will incur if we fail to pay off our credit cards in full. Every month we carry a card balance, we get charged interest on that unpaid balance. It is like investing, except the time is our enemy, not our friend.